The year 2023 has been absolutely crazy so far. Despite obvious problems such as ongoing wars, bank failures, the debt ceiling crisis in America, concerns about a recession in Europe, and the American crackdown on cryptocurrencies, the stock market seems to be ignoring all of this, and the famous S&P 500 index has gained over 14% since the beginning of the year. Even my stock portfolio hasn't had a single negative month this year and has gained over 33% since the start of the year. But let's go further. Some stocks, like Meta, have gained over 100% since the beginning of the year, and growth stocks like Palantir seem to have caught a second wind, gaining over 150% since the start of the year. I guess those of you who bought during the market downturn last year are at least somewhat profitable this year. However, if we look at the famous indicators of fear and greed, we can see that we have transitioned from fear, which dominated last year, to a significant level of greed this year. Investors seem to believe that everything will go up from now on and that a healing phase has begun. This is how a part of one investor's portfolio from our investment community looks like. But this is just a superficial understanding of the whole problem. That's why in today's video, we will show you the data, graphs, and discuss what is actually behind this enormous growth and why many famous names say it's a problem and what you should do about it. Hello, we are Invest Guide, and welcome to another investment video. As I mentioned before, the S&P 500 index has gained over 14% since the beginning of the year. So, if you are a passive investor in ETFs, you have essentially gained over 14% without doing anything since the start of the year. But here's where it gets interesting, because only 3 sectors out of the 11 that make up the entire stock market are responsible for the entire market growth. Information technology, which includes companies like Microsoft and Google, and communication services, which include companies like Meta, are literally keeping the whole stock market afloat. But wait, it gets even better. We know that the S&P 500 index, which you can find with a ticker like VUAA at a broker, consists of the 500 largest American companies. The top 10 largest companies are mostly technology companies like Apple, Microsoft, Google, etc. What's even more insane is that these top 7 companies in this index account for a 77% increase, essentially all of the stock market growth. Simply put, the top 7 companies in the S&P 500 index keep the remaining 493 companies afloat. You may not realize it, but such a high concentration in this index is quite rare, because the average stock in this index is actually down 1.2% this year. And it's only a few select stocks from this index that are up by tens or even hundreds of percent this year. Take a look at this graph with me. Amazon, Apple, Microsoft, Google, and even NVIDIA are up an average of 47% since the beginning of the year, while the overall market is up only 14%. These big technology companies, along with Tesla, currently make up 30% of the total market capitalization of the famous S&P 500 index. And that brings us to 2 messages, 2 things you want to hear. I won't keep you waiting. Let's start with the bad news. Most of these big names that essentially drive the entire stock market have currently jumped on the artificial intelligence revolution. Companies like Microsoft or Google have added hundreds of billions of dollars to their market value just because they incorporated artificial intelligence into their operations. But here's the catch: what goes up quickly in the stock market tends to fall quickly as well. Some of you may still remember the dot-com bubble, the internet frenzy of 2000, when stocks of these companies plummeted by 80 to 90%.
What in the world is happening on Wall Street?
There is already speculation in the world about when the artificial intelligence bubble, the artificial intelligence frenzy, will burst. And essentially, if the price of these inflated big technology companies falls, it will naturally drag down the entire index, the entire stock market. But we also have good news, because when we see the overvaluation of these technology companies today, we can actually see and buy value in other sectors that may not be technology related, because many companies are still reasonably priced. If you were smart, you bought technology companies last year when they were heavily discounted. As I reported, buying companies like Meta, Google, Apple, Microsoft, etc. Now, there is a big question mark about the valuation of these companies. However, we can also see value in value stocks, in dividend-paying stocks that haven't experienced such significant growth. When we look at some analysts who predicted an apocalypse in the stock markets this year, we now know that they were likely wrong.
The whole crash is going to be 80 to 90%.
We have talked here several times over the past 2 years about how staying out of the markets for a long time is a mistake, and that time in the market always surpasses market timing. And now a big problem arises, because news, not only on Instagram or Patreon, is filled with typical messages like, "Hey, Invest Guide, what do you think about NVIDIA? What do you think about Microsoft? should I buy their stocks today? It's a good price. And I say, hey, where were you last year when Palantir was at $6, when Microsoft was at $245 instead of $250, when Google was below $100? It always happens like this. When something quickly grows, everyone asks, should I get on this train that's already running? But when stocks are undervalued, suddenly no one is interested. When I look at it, my average purchase price for Microsoft is around $240. The same goes for Meta. Yes, it made sense for me to buy it at around $100 to $150 because I believed in Zuckerberg. I said that I believed he would turn the company around. Besides, the price back then was absolutely below its intrinsic value, and it was a no-brainer. But of course, at today's prices, I wouldn't take it. When we talked about the companies that currently hold the entire S&P 500 index above water, they were Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, Tesla, and NVIDIA. And I have 6 out of these 8 companies in my portfolio. And that's why my portfolio is doing well this year. Because I bought these technology companies when they were down last year, because I believed in, based on my experience, I expected these great companies to recover. Here you can see the development of my portfolio compared to the index at one of my brokers. It's the million-dollar question whether it will last. When I look at XTB's calendar, I see that we had inflation results in the US, which ended relatively well. Inflation in the US is decreasing and is now at around 4%. Decreasing inflation means that the Fed, the US central bank, should start lowering interest rates at the beginning of next year, which means people will start borrowing and spending more money in the economy. As the stock market always looks ahead, many investors are already excited that they will make a lot of money in the stock market based on historical data since 1970, every time the cycle of interest rate hikes ended. So, what is expected next year? I remind you that every time, the stock market delivered an average return of 14% to investors in the following year. According to historical data, it suggests that stock markets should continue to grow next year. Personally, when I look at my portfolio, I don't intend to buy technology stocks at these prices. For me, they are simply too high. The only sectors I like are real estate, banking, and healthcare. In XTB, I have REITs like VC, WP Carey, and Realty Income for real estate, for example. VC is currently high, so I'm not interested, but I like Realty Income or WP Carey. If their stock falls below $70, which is honestly not far off, I would consider it. Otherwise, if you are interested in more detailed information, I wrote an approximately 8-page article about it on Patreon. You can find it there, discussing the current market situation, what to expect, and which stocks to consider. Now, I see value in specific stocks and what I want to buy for the future growth of my portfolio. So, take a look there if you're interested. We talked about how only a few stocks account for about 30% of the entire index. Now, I'll show you why I personally believe that in the near future, we will see a decline in these technology stocks. There are 2 ways in which ETFs are constructed. The first way is when you have 10 stocks, for example, in an ETF that tracks an index, and each of these stocks has a 10% share. So, their weight distribution is equal. The second way, which you are probably more familiar with, is when the percentage distribution of the ETF's index is based on market capitalization. The larger a company is on the stock exchange, the higher percentage it has in that ETF and index. For example, Apple is the largest company in the world, so it has the highest share, around 7 or 8%, in the entire pie. But what is happening this year, which is very unusual, is that the distribution of the S&P 500 index based on market capitalization, which is probably more familiar to you, has a return of over 14%, while the equal weighted distribution, where each of the 500 companies has the same percentage in the pie, has a return of just over 2% this year. This is the largest difference between these variants since 1990. The difference between the market-weighted index and the equally weighted index is massive. This is not common at all. Historically, the equally weighted index, where each of the 500 companies has the same percentage representation, usually outperformed the market cap-weighted index. Look at the past few years. In the last 20 years, the S&P 500 index, which is equally composed, has significantly outperformed. The stock market is generally considered healthier when individual companies grow together. However, this concentration of the market in just a few names has historically led to corrections and larger market declines. Especially now, if we look at this graph, it shows that money and liquidity in the US are drying up, and it's the worst it has been since the collapse of Lehman Brothers in 2009. This lack of liquidity can be a problem for these large companies in the future. So, the simple answer to your questions like, invest guide, should I invest in large technology companies like Apple, NVIDIA, Microsoft, Google, etc., is no, you shouldn't. It's not the right time. The right time was last year when these companies were down. Most investors were leaving these companies. Everyone doubted Meta, doubted Zuckerberg. That was the right time to buy. Now, the right time is gone. However, can Microsoft grow another 20 to 30% to reach a $3 trillion valuation? Sure, it can, but the chance of that happening is much lower than Microsoft and other companies experiencing a correction in the near future, and we might see a drop in their stock prices. Even when we look at my favorite stocks like Google, even though it's relatively a good price for Google, I'm not buying it anymore. I bought it last year. The rule is quite simple. The best time to buy is when most investors are running away from those quality stocks. And let's be honest, that's the hardest task. When Meta was below $100 per share, everyone was disregarding it. People thought the company would go bankrupt, but that was the best time to buy. However, I don't want to underestimate the difficulty because it's still a challenging task. If we look at history, statistics, and graphs, this overconcentration of just a few stocks, around 30% of the entire index being accounted for by 8 names, indicates that this market concentration will likely lead to a correction in the indices in the future. Alternatively, the second option would be further growth driven by undervalued dividend stocks and value stocks. So, it's not a good idea to change your investment strategy just because you missed out on this significant growth in technology stocks. There will be other opportunities. The doors in the stock markets open every day. And if you have made investments, congratulations on your profits. If you would like to see my entire portfolio or know about all my purchases or sales as soon as I make them, or if you want to learn how to invest, I would be happy to see you in our investor community on Patreon. The link is in the description. Also, if you want to know exactly how the financial scams in the Wolf of Wall Street happened, which you probably don't know, check out this video. Take care.